There's only one way to put it, and Zach De La Rocha was referring to exactly this moment in market history when he said, "Bulls on parade." We've got some monthly time frame charts to look at in today's episode, but let's do a full roundup of all of the data points now that a direction has been chosen and build a game plan for the upcoming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not done so already, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With all of that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame, talking about candle structure and location as we always do. The candle in question is the second one. This is just a couple days of June. For the most part in May, we do have a structural hammer candle. In the lower wick, buyers step up and they're able to push prices back up to the opening print. And because we have a green-bodied hammer, we know that they go through the opening print to close towards the highs of the monthly range. And there's not really enough upper wick, especially in relationship to the lower wick in terms of size, to read into from a selling pressure perspective. So overall, buyers are in control from a structural point of view. If we think about location on the bar-to-bar count, we've produced equal lows and a higher high. That as well strikes me as a bullish data point, but it goes further than that. If we take in the context of this as an inverted head and shoulders, we know that this neckline is something we've been watching as of the previous monthly bar break above the neckline, and the lower wick would sort of act as a break and retest on that neckline, confirming what was once resistance in all of these areas here is now potentially acting as support. That is a bullish dynamic on the monthly time frame. If we scrunch this up and take a look from our sickness low to the all-time high with a Fibonacci, I just want to point out that if the bears were going to be making more substantial progress in the downward direction, we would have kept prices, or bears would have kept prices, in no man's land. That's between your 38.2 fib and the 61.8. Obviously, we're rotating back away and above the 38.2, which technically classifies this as healthy bull flag consolidation on a monthly time frame. And if you wanted to be more nuanced and approach this as a monthly bear flag, well, it certainly hasn't broken in the downward direction. And if we take out the Fibonacci's from the all-time high to the October lows, you'll notice that we are in no man's land, threatening a move back above the 61.8. And just remember, whenever we recapture a 61.8, the odds of a 100% retracement dramatically increase. Once again, if this was going to be a healthy bear flag, just like in the inverse case for the monthly bull flag coming from the low to the high, we wanted to see, or bears wanted to see, prices underneath the 38.2. Obviously, it's not the case as of these most recent closes on the monthly time frame. If we drop it on down to a weekly time frame chart, let's just remove those Fibonacci's for now and take a look at what's going on here. I mean, structurally, we also have a bullish bar. It's very similar to the monthly bar we were just looking at, but I would say that this is even better because, of course, on a location perspective, we have formed a bar-to-bar higher low as well as a higher high. So is the weekly chart in an uptrend? Absolutely. At this point in time, we've been counting trend with lows, higher lows, higher lows. These lower wicks were higher lows, and along the way, this was our first high in that upper wick, higher high, higher high, higher high, higher high. So weekly trend is also up. All of the higher time frames right now are actually pointing to more potential upside. Now, it is worth understanding where we're at in the trend sequence and acknowledging that whenever we produce a higher high, it's very reasonable that the market could pull back and look for some sort of higher low. Now, in a picture-perfect world, we've been tracking this as kind of an ascending triangle, right? On the weekly time frame chart, we've been talking about this pattern here. So if this is going to turn into a break and retest, I mean, we already technically did in the lower wick of last week's bar, but a red bar on the weekly that supports above the top of this sort of pattern would not be the end of the world for a break and retest here. If we throw on our anchored view apps, it should go without saying at this point in time, we're probably going to stop bringing these up, but obviously we're rotating away from that in the upward direction. And if we throw on our volume profile, it's really noteworthy that, of course, we're pushing away from this high volume node. We're rotating into this thin volume void, and the next overhead high volume node as a target, as we called out in prior videos, is closer to 440. Now, once again, not making the call that we go there this week, just continuing to point out from a volume perspective, we're kind of entering a void where the rotation higher should be easier rather than more difficult. And once again, if we do pull back to sort of retest that high volume node, we're using it as support this time around instead of resistance. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound here, the number is going to be 433.50, and that of course just implies a big higher high. If we're contained by the lower edge of the expected move, the number is 422.30, and that would imply a higher low. So expected move here is bullish, and it's also worth pointing out that the lower edge of the expected move is also in alignment with a gap fill reversal level. It's also in alignment with the equal high break from the Thursday into Friday session. So it's structurally significant on top of being significant from the options pricing perspective. The trend is clearly up here. That goes without saying. We have lows, higher lows, and we also have highs, higher highs, and now a higher high as of the close on Friday. So with that in place, just like on the weekly time frame chart, we can certainly look for a higher low pullback, aka a move in the downward direction, and it wouldn't really be jeopardizing the trend at this point in time. That's noteworthy because once again, in this sequence, it's probably not wise to be a new money buyer sitting on this higher high as we approach structural resistance at 428.50. We'll see where that comes from in just a moment. But for now, I want to talk about a pattern that's taking place. Obviously, Friday is a gap and go. That's a sign of strength from the buyers right out of the gates. But the bigger pattern that's in play here is that the April month and a half, almost 2-month long balance range has finally broken in the upward direction. We were sort of talking about that on the Wednesday midweek market update, but we're always looking for a range double whenever we break a significant range like this, and we're basically home at that target. So once again, would I be an advocate for a new money buy, a new money long position up here at these highs? Probably not at this point in time. The more ideal situation on the daily time frame chart is looking for that pullback that we just described to this area around that 422.50, 422.30, lower edge of the expected move, gap fill reversal. That would certainly imply or produce much more of a risk-friendly entry if we start to see intraday patterns that would suggest a reversal could come from that area right down over here. Of course, a line in the sand on the daily time frame chart now, the place that we do not, absolutely do not want markets to go back down underneath, would be 417.25, and the reasoning behind that should be quite clear. We just do not want this to turn into a fake break attempt and rotate back down into the quote God-forsaken range, as we've been calling it here on the channel. What else is going on here? Of course, if we throw on the anchored view apps on the daily time frame chart, this should become abundantly clear as well. These are anchored to all the major pivot points after the October low, just reminding you folks that we've been above them for quite some time. They become less relevant in our analysis as we get further and further away from them, but even if you anchor this to here, the lowest point of the April balance range, we're firmly above that, and over time, it will start to coincide for confluence of support at 417.25, building the case that this will likely be a line in the sand as we continue to move potentially higher here. If the market does not want to pull back and it just continues out of the gates early on in the coming weeks worth of trade, it's going to be a bit difficult to sort of get involved on the long side, and for the reasons that we just discussed, right? For the most part, you don't want to be buying on a new higher high here, especially with some continued bad breath out there in the market. So instead, what I would advocate for is be patient, wait for the break to actually unfold, and then watch for a pullback that then retests that breakout level. From there, you can start to look for those more concrete upside rotations with better risk reward in play. So 428.50, just as a reminder of where this is coming from, is back here. It's the little upper wick rejection before this fall off takes place. And then 431.75 is this high. Beyond that, we have 437. Once again, not making the call that we get there this upcoming week, just pointing out where those targets are going to start to be. Let's move on down to the hourly time frame chart where we can really get granular on how this structure may actually unfold. I want to be very clear here that on Thursday and Friday of last week, this is not the same type of short squeeze rally as what we saw on the Friday of the prior week, which was really spurred from the whole NVIDIA earnings move, right? And I can prove this to you if we take a look at a 15-minute time frame chart. Look at how on the morning of Thursday session, there's an attempt at a pullback first. So sellers had their opportunity, but buyers start to overwhelm. The same thing takes place on the Friday session, right? This is not a short squeeze out of the gates. There's an attempt from sellers to drive it lower. We actually take out the opening print, try to close the gap. It just doesn't happen. Buyers are too strong, and we close up towards the top of that daily range. So if we compare both of what happened in the morning sessions on Thursday and Friday of last week to the prior Friday, the one before that, where the short squeeze took place, notice that it's literally straight higher out of the gates, small little 15-minute consolidation, and then continuation. Look at the size of these 3 candle bodies right here versus the candles that grind up through this move in here on Thursday and in here on Friday, right? 2 totally different circumstances. This is incredibly important to understand because this means that new money buyers are getting active. The structure underneath us is much more healthy compared to what took place last Friday, and we should be more along the sides and aligning ourselves with being believers of this rally instead of skeptics saying, it was just a short squeeze, it's not new money buying. There's a couple of other things we can look at. Let me just go back to an hourly time frame chart that provide confluence of support here on the hourly time frame chart. If we come in with our Fibonacci's from the low of last Thursday, not the Friday rally, not the Wednesday true low, and do something like this, your 38.2 is roughly in alignment with that 422.30 area. So once again, from a bull flag consolidation perspective, a reasonable pullback probably goes here, gives us a gap fill reversal. We respect the 38.2. That's your ideal pullback. If we do another Fibonacci coming in from the low of the Thursday session where that first intraday pullback takes place, right, to the high of Friday, and we analyze this move, we could also look for a test to the top of the gap, just a 100% retracement of Friday's activity. And if we support there, that would also seem very reasonable based on a Fibonacci analysis. If we do actually replace this fib back on the screen, what you'll notice is that your 61.8 gets fairly close to 417.25, and if we start getting underneath that area once again, that's not really what the market wants to see if we're going to be constructive in the upward direction here. So once again, what are we watching for early on in this week's worth of trade? If you're trying to trade long, you're looking for a pullback to here, looking for any reversal patterns at 424. If we break down through it, you could probably short that on a scalp to look for the rotation to close the gap. Then you're looking for a gap fill reversal. Any hammer candles go, any intraday double bottoms, inverted head and shoulders, all of that good stuff goes around this area right here in the market. Anything deeper than that, your level and line in the sand is 417.25. If you're more convinced on the short side, you can trade this pullback short, but I wouldn't overstay your welcome at these areas of potential support. So what that might look like is perhaps a breakout or an attempt to get over 428.50, comes back down underneath, forms a lower high after a lower low from here to here. It would have to be nuanced intraday, right? Then you take out that low, that's where you can start to trade short for that pullback to unfold in the first place if you're trying to capture some downside. Other than that, there's one other thing I'd like to show you on the hourly. It's the intraday anchored view app from last Thursday's, I guess it would be 2 Thursdays ago, session. And once again, as we start to trade this early on in the week, this will slowly start to creep higher and potentially provide confluence of support closer to that 422, 422.30, 50-ish area. And I would be looking out for that. If the pullback takes a day or two to unfold, if this is finding support here as well, that would be an all eyes on level. The bears only have a more solid edge on the daily time frame chart in this S&P 500 for a trend reversal if we start producing a significant pullback to here and then produce a lower high underneath 422.50, 422.30. That's where I start to get concerned on the daily time frame chart for perhaps a head and shoulders to emerge, but we're not there yet, and the bulls clearly have an edge as we come into this week's worth of trade. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Overall, did we have significant volume inflows on Thursday and Friday? The answer to that question has to be yes, both breaching or achieving positive 300 million individually. If we look at the net cumulative flows on the week, we closed at positive 450 million, but remember it was a shortened holiday trading week, so I'm not concerned that we didn't exceed positive 500 million, our normal threshold. If we look at the advanced decline line, we get to trend zone on Thursday and we get in and above trend zone on Friday. The cumulative builds down below in the tick speak for themselves. Is this evidence of new money buying? I would have to say yes, especially in conjunction with the structure we saw on the 15-minute pullbacks early on Thursday and Friday. This is not just short squeeze. If we compare these internals directly to what we had on 2 Fridays ago when there was the short squeeze, notice that we do not have significant volume inflows. The advanced decline line never gets up or touches trend higher zone, and the cumulative tick looks embarrassing in relationship to what we just got on Thursday and Friday. Was it reasonable to be skeptical of the short squeeze 2 Fridays ago? Yes. Is it reasonable to start respecting these with more authority from Thursday and Friday of this previous week? I would have to say yes. Market profile is always Exhibit B, and once again, I've got a video tutorial for you in the top right-hand corner if you're not familiar with this screen. For the most part, what was going on with value and the point of control on Thursday and Friday? Well, on Thursday, value area shifts higher with price, as does the point of control. On Friday, value area shifts higher with price, as does the point of control. Once again, an indication that new money buyers are willing to commit volume at these higher price points. Another thing to take away here is that these profiles are trending profiles. Although they look thin and drawn out, we don't really have that very distinct P shape where we have a single print post like we did 2 Fridays ago, right? If we look at the short squeeze rally, notice how back in this profile, we have a very distinct P shape with only single prints making up the post. That is what we would refer to as a short squeeze profile. And these are trending type profiles where you can clearly see some overlap in the TPOs. These are much more healthy and indicative of structurally significant buying, not just emotional get me out of shorts. If we think about what's going on here, sure, there could be a retracement through some of what is deemed as quote unquote thinner structure, but it has different psychological implications is the main takeaway, sort of the same idea as what we discussed on the market internals. If we look at Friday's session specifically, it does start to resemble more of a double distribution, being separated by a single C print right here. If we are accepting early on in the coming weeks worth of trade, so over 42.75, over 42.75 is probably more optimistic for bull flag consolidation and will eventually look for a break of those highs. If we start breaking into the lower distribution underneath 42.75, it's not the end of the world because we know we can afford a pullback, but as in if we start accepting into that lower distribution, you should probably be open to potentially trading those pullbacks in the downward direction. A great first target, as we know, would be the gap fill reversal from the Thursday high, right? And that in the ES is going to bring you closer to 42.40. One last thing I want to point out here on the profile before we continue along is that Wednesday still has a poor low. It's going to be in play when and if we come back and test it, but as of right now, it shouldn't be the first thing that you carry forward into this week's worth of trade. Jumping back on over to the platform to evaluate the weekly performance of our sectors starts to reveal what might look like red flags at first glance, but we'll see why they're not in just a moment. Energy leads the pack this week, up a whopping 3.23%, followed by materials and healthcare. Now, energy, materials, and healthcare are either lightweight or D for defensive. Obviously, the XLV is the second heaviest weighted sector by market cap, but it is D for defensive. So you would think that posture here really isn't all that great, especially considering that the only red name on the board here, the laggard of the week, is the XLK tech sector, our heaviest weight risk on sector. So at first glance, kind of concerning, but if we look at these structural charts, we'll start to learn a little bit more and why it's not the end of the world. Energy, for example, really lightweight and D for defensive sector. Did it produce a higher high? The answer has to be no. So although it outperformed on the week, it didn't structurally start to exhibit leadership. Not concerned with this chart. If anything, upward pressure is upward pressure for the market. If we look at something like the XLB, materials, really lightweight sector. Did it produce a higher high? The answer to that question is no. It's just produced an equal high, just like we saw in the energy sector. So is there leadership here? I would have to say no, not really. Not concerned with the passing of the baton. If we look at the XLV for healthcare, as we pointed out, second heaviest weighted sector by market cap, we can't afford for it to be falling off of a cliff. The fact that this was happening was really concerning, right? We know that it's D for defensive. We certainly don't want it outperforming, but we don't and we can't afford for it to be falling off of a cliff. This sharp reversal into the end of the week is really impressive. Is it exhibiting leadership? Once again, the answer is no. Did we produce a higher high? The answer is no. But the one thing that the XLV has done is it's avoided a lower high here underneath that 129.50 level we were talking about in the Wednesday night update. Next up, let's take a look at industrials, another big outperformer on the week. If we look at where we're at in this overall range, are we exhibiting leadership over the top? The answer is no, and upward pressure is upward pressure. Real estate, this is classically much more to do with the wealth effect. Are we back in the range? Yes. Is it exhibiting leadership over the top? No. Is it good and comfortable from the wealth effect perspective? Absolutely. If we take a look at something like consumer discretionary, what's going on here? Gap and go on Friday. This is certainly a place where we do want to see leadership. It's producing higher highs from this perspective, and now we have an equal high with this prior pivot top. Does this chart look bullish or bearish? I would have to say that it looks bullish. What are we looking for here? Ideally, once again, it pulls back off of the equal high, closes the gap perhaps, and we look for any sort of excuse to go long XLY or be a supporting piece of bullish evidence if we're above 153.75 on a gap fill reversal. Straight up continuation over 157, target 160.150. This chart is a bullish data point for our markets. If we look at financials, this was a big red flag for markets as we were moving into, really this previous little downdraft right here. Now, if you recall from the Wednesday night episode, we said if the markets were going to move higher, we want this hammer candle on the XLF to resolve in the upward direction. And did it resolve in the upward direction? The answer has to be yes. We have ourselves an equal high. There's no longer a threat of this turning into bear flag consolidation. There's no longer a threat of a fake break producing a lower high from here to here. The trend is neutral now in the XLF with highs equal highs, lows equal lows. So can we look for a breakout? Yes. Could we look for a higher low pullback? Yes. And that would be constructive for the beginnings of a new uptrend in a very important and risk-on heavyweight sector for our markets. So liking what we're seeing out of the XLF. XLP, D for defensive, right? Falling off of a cliff here, finally starting to put the brakes on just a little bit. This one's a little bit more concerning, right? If we think about retail spend and what's going on with the earnings calls that have been coming out from the retailers, right? Not really all that convincing. Strong opportunity for a lower high, but if there's an opportunity for a lower high, and it's going to be anywhere, we want it to be here in the XLP, which is D for defensive. I like what I'm seeing out of the chart. Let's not see it continue to fall off of a cliff. Let's see it go sideways. That would be helpful for markets. XLC communications, much more to do with risk on, not as heavyweight as the XLK and XLY, but nonetheless, this chart looks bullish to me. We've just produced higher highs. We can reasonably consolidate over 62.15 and look for continuation. The only time this gets concerning is if we get a deeper pullback underneath 62.15 and perhaps a lower high underneath. It's not a problem yet. We'll keep an open mind to that. If we take a look at something like XLU for utilities, lightweight D for defensive, bear flag, putting in some sideways activity now, bullish engulfer on the Friday session. If it does start to creep higher, is it exhibiting leadership? Nope, not unless it wants to get all the way up and over 70. So upward pressure will be upward pressure for markets. Last but certainly not least, perhaps the most important sector of them all, although it was red on the week, does this chart look bearish to you? Does this chart look bearish to you? The answer to that question in the grand scheme of things right now has to be no. Could we see some pullback? Absolutely. Are we sitting on what could potentially turn into a double top here? Absolutely. But remember, it's not a double top until it is. You need to wait for the break of 163.65 and then perhaps look for a deeper pullback to unfold. Some targets would start to become 160.75 and then the gap close underneath. But even from that perspective, we're searching for a big weekly higher low. If we consolidate here and put in the most ideal pattern, it's going to be a daily bull flag and then eventually long over those flag highs will continue to push this market in the upward direction. So sector-wise, I'm not really seeing anything that's a massive red flag. Here's the sector ratio grid, and if you're not familiar with this one, check out the tutorial in the top right-hand corner. This confirms everything we just discussed about the structural charts. Even though the posture doesn't look great here, the structure suggests that everything's fine. This reinforces that idea. The heaviest weight risk on sector, the XLK, looks absolutely phenomenal. Strong push away from an upward trending 50 SMA. Minor pullback, certainly welcome at this point, not a threat. D for defensive, XLV. Is it outperforming even though it had a significant move to the upside? Absolutely not. XLF continues to be the thorn in the side for the S&P marketplace. This has not been helpful for quite some time. If it's trying to put in a bottom, that would help, but we don't have that concrete evidence yet. XLF continues to be an issue. We want to see improvement here. XLY continuing to outperform. The closest tie risk posture-wise to the XLK is communications, continues to stay strong above an upward sloping 50 SMA, mild pullback into the end of the week, and perhaps the biggest takeaway, right? Although we saw defensive posturing with energy outperforming, look at what's going on with the risk off sectors. I mean, the bottom four here speak for themselves, continuing to drift lower, drift lower, drift lower, drift lower. There's no indication here of risk off coming in with a stronger look. XLY risk on versus XLP risk off. We just produced an equal, if not slightly higher high. This is a risk on indication, and we can afford a higher low pullback. It wouldn't be the end of the world, but as of right now, the posture is supportive of risk on, not risk off. As we move away from the S&P price action and into supporting market relationships, I want to remind you that everything we look at is one data point in the web of analysis, and perhaps the biggest lesson that we've learned over the past couple of trading weeks is even if there are bearish divergences across market relationships, price action will always reign supreme, and unless there's a price action setup, you're not going to go short or long just based on a divergence. So with that said, the dollar is actually pulling back into the end of last week here, supporting the move higher that we saw out of equities. But will it find support at 103.50 is the key question. It's been a big inflection point for the dollar in the past here, and there is evidence to suggest that this will hold as support. And if we rotate higher, that wouldn't really be all that great for equities down below. The primary thing that I'm looking at to support that claim would be the gold contract, which clearly rejected underneath 2,000 into the end of last week. As and if this continues lower, in theory, it puts upward pressure on the dollar, thus downward pressure on markets down below. If we take a look at the 10-year, which is the interest rate, this is also putting in a break and retest on the top of its range at 36.40. Now, the jobs numbers came out extremely strong, and the Fed is sort of hinting at what they're calling a skip in the next meeting, and then looking at one more rate hike into the midpoint of this year. So if rates hold here, in theory, that puts more downward pressure on the XLK. We have not seen that come to fruition yet. So the main thing I would be watching for is day to day, what are rates doing and how are we responding to the incoming data? Let's take a look at some fundamentals. So the tracker tool is back to showing higher odds of a pause for the next meeting, although the Fed is using the term skip, and that meeting is going to be on June 14th. If you were paying attention, Harker came out a number of times this week and reinforced that idea of a skip, being careful not to use the term pause, which could potentially signal that there won't be an additional rate hike after this pause, because if we go to the probabilities tab, we know that technically we're looking for a pause, and then we are looking for one more rate hike into the midpoint of this year and then start cutting from that higher location. Now, to me, this is interesting because the Fed's very cognizant that they've made some progress and they don't want to undo that progress, right? The jobs data continues to come in phenomenal, supporting the soft landing idea. If we just take a look at our calendar here, right? The numbers from last week, look at the massive beat in non-farm payrolls, right? 339 versus 193. We'll keep an open mind if they revise those numbers down, but at first glance, really strong jobs numbers. The unemployment rate still remains at pretty much record lows at this point in time. And it's pretty clear that goods inflation, you can see the manufacturing PMI here, is still in the contractionary territory. The main thing that the Fed wants to see right now is the services PMI here. The services is the sticky inflation. Is that going to cool off as well? You can see that number being above 50 represents expansion. That's more inflationary. So the Fed wants to see that cool off. Is that going to be the thing that determines whether or not we get that 25 basis point hike in the next meeting or not? Perhaps, but we are entering a blackout period where the Fed speakers can no longer come out and make comments. It is up to us to sort of interpret the data. I would say that you want to watch for this to come in at or below forecast if we're going to remain at a pause. If it comes in super hot, then I do think that the Fed's hand may be forced in raising rates prematurely, even though the tracker tool here is showing us that we want to go for a pause right now. If we actually go to the compare tab, you can see that the expectations have been quite volatile. In here, there actually was an overwhelming majority who believed that yes, we would be getting a hike in the next meeting. I think that services PMI will be a big one to watch. We'll speed it up through the risk appetite charts. Notice that there is no flight to safety trade taking place here, printing a new lower low. If we take a look at something like our HYG, our junk bonds, you'll notice that they did actually produce a higher high in conjunction with markets producing a higher high paired with a higher low. It doesn't undo all of the negative divergences that we were seeing prior, and there still is certainly this major negative divergence with the higher high versus lower high. That's definitely still there, but once again, we cannot short markets just because this is in place. We've seen how that's gone over the past couple of trading sessions in here. I also want to point out Bitcoin. We haven't looked at the Bitcoin chart in quite some time here. If we zoom in, this is a weekly time frame chart. As we breached the prior low in this green doji, we can't really see that on the weekly. Let's go daily. As we breached that prior low, you would have expected right here that the sellers tried to make a stand and push prices lower. It simply did not happen. It's not a one-to-one risk appetite relationship to equities, but this certainly does suggest more of a bullish environment than a bearish environment. Nicey new highs versus lows did technically close positive, but it needs to improve beyond this. If we take a look at stocks trading above their 200 SMA in the S&P 500, it closed at the 50% mark, but once again, it needs to improve beyond this. If we take a look at something like the SPX A50R, this is now a daily time frame chart, one-to-one with what we see underneath. As we're continuing to push in the upward direction, we still have not been able to breach this area of local highs right here. We're also just coming into the 50% mark. That is a big cause for concern. This continues to stack up as the biggest negative divergence in my estimation. If we take a look at something like the RSP for our equal weight S&P 500, it's nowhere near taking out the top of this range, whereas clearly the S&Ps not only took out the top of that range, but they're well above this prior equivalent top as well. Those are almost one in the same, another big negative divergence here. If we take a look at the Dow transports, this is where things get a little bit interesting. Dow theory actually isn't all that bad right now. If you just extrapolate this prior top right here, it's almost the equivalent of this in your transports. And notice the distance between the two. Notice the distance between the two. This was a cause for concern as transports were breaking out. And we were like, whoa, let's dial it back a little bit. But remember, they came back into sync as we came back down underneath that level. Now these are much more aligned. And this actually strikes me as an okay data point supporting the rally we've seen thus far, at least in the Dow. The VIX just produced the lowest reading on the chart in front of us, but the key question now becomes, is it too low? Do we need to see a shakeup in volatility off of quote-unquote support? And the answer to that question would appear to be no, based on what the VVIX is telling us, volatility of volatility. We just broke down underneath this trend line, and there's some room to continue down towards the 75 handle. When and if we get here, we will start to consider the complacency effect, but we are not there yet. If you're not a believer anymore in 30-day VIX options, that's fine. You can take a look at your volatility futures, working deeper into a contango, and the 9 versus 30-day VIX also working deeper into a contango. If we look at the 1-day VIX, the range of Friday's session is extremely compressed, some of the lowest readings that we've seen in the limited data set that we have in front of us. Something that we talked about on Wednesday was the skew, and I know not a lot of people saw that video, but if we just drag this across, you'll notice that elevated skew levels do not always coincide with downdrafts in the market. A big primary example of that would be through this segment of the chart right here, right? Think about what this implies. This is speaking to 30-day tail risk. People are positioning for a potential black swan event. Does that black swan ever have to come true? The answer to that question is no, which is why the extreme upside readings are not as important as the extreme downside readings. The extreme downside readings would suggest that, okay, everybody's thrown in the towel after positioning for a black swan event, and thus good things can start to happen when all of the bears sort of quote-unquote capitulate at the very bottom. QQQ monthly time frame chart speaks for itself. Candle structure is clearly bullish, solid green-bodied bar. On the bar-to-bar count, we have, of course, produced a higher low and higher high, and we've broken out of a bullish 3-bar play with an inside hammer preceding. All of that, of course, stacks up as a bullish data point. Now, if we think about the inverted head and shoulders, there's simply no right shoulder. Very minor, I suppose, if you want to count that inverted hammer, but for the most part, the lack of shoulder there would just suggest that buyers were ready to go without even really producing a significant monthly pullback first. Once again, another bullish data point. If we come in with the Fibonacci's from the low to high, we're certainly back above the 38.2 here. That does strike me as being more bullish than bearish. And just like in the S&P, if this was going to become a monthly bear flag, fine. Bears, you've got to keep it underneath the 38.2. What's going on here? Why are we testing or even above the 61.8? Not really seeing anything bearish here on the monthly time frame. Does it mean we can't get a pullback? No. I mean, of course we can get a pullback. A pullback is a reasonable part of any trend, but as of right now, bulls are firmly in control of the overall structure on the monthly. If we look at the weekly, it's very clear that the same thing is taking place. Brand new higher highs, gap fill reversal, hammer structure in play, higher high, higher low, the whole 9 yards. Bulls on parade is the name of the game at this point in time. However, it's difficult to be a new money long entering at incredibly bad location. You should probably be looking for pullback entries only at this point in the market and be very skeptical about taking breakout continuations. You do not want to position with bad or perhaps the worst trade location of this rally thus far. If we take out our anchored view apps on the QQQ, I mean, this is not even in the picture anymore. It's not even relevant. That is a bullish data point pushing away from the all-time high anchored view app. We're moving away from this high volume node. I suppose if you were looking for an inverted head and shoulders, there's your very minor right shoulder on the weekly time frame chart, clearly breaking that neckline. We're not even close to coming in for a retest yet. Could the weekly time frame chart, in theory, get a pullback that goes all the way here and then reverses off of it? Absolutely would not jeopardize the trend at this point in time. Of course, intraday, it's going to produce some serious downside outcomes that you can be trading for, but the structure, at least the trend, will not be jeopardized at that point in time. The next overhead high volume node to be targeting on the weekly also coincides with structure. See it there. If we drag that across, it's very close to QQQ 370. Let's take a look at our daily time frame chart for the Qs and make an assessment for what we have on tap for the coming week's worth of trade. Expected move here, of course, has to strike me as bullish with a higher low and a higher high. It's actually more of an equal low if you want to count this as the last major pullback for your QQQ. The line in the sand pullback is going to be at 346.75 because we do have thin structure from that sort of short squeeze rally 2 Fridays ago that we need to be mindful of. Anything that's better than that, the most optimal outcome would be just consolidation here above the 2 equal high breaks. We did get a gap fill reversal on Friday, right? Then we look to close the gap overhead. That's from 356.79 closes to 359.88. The expected move numbers are going to be the upper edge at 361.53, lower edge at 347.75, almost coinciding with the equal low, and once again, line in the sand at 346.75. Here's the hourly time frame chart. Once again, whenever we see a chart like this, we have to be very skeptical about positioning for bad location on the upside. To get involved in the upside, it's either got to be consolidation and then a break, or if we do break, you probably want to get involved on the first higher low pullback that is offered above the breakout point here. That level is 355.25, and once again, your gap is going to close overhead as a target. Shorts can trade this in the downward direction for the pullback to unfold. I like the structure here better on the downside than the S&P 500 because there's cleaner levels to trade against. Any consolidation that fails, you're clearly getting short on lower highs under 352.75 and looking for the outcomes into 349. And once again, your line in the sand pullback level at 346.75. Shorts, please don't overstay your welcome here, but you are looking for that rotation as a reasonable pullback. It's at least tradable intraday, correct? If we take a look at our market internals, they sort of speak for themselves, just like the S&P market internals speak for themselves. Significant inflows, not all the way there on the Thursday session, but certainly on the Friday session. Advanced decline line, not all the way there Thursday, Friday getting a little bit better. Cumulative ticks speak for themselves. If I had to compare and contrast the two, obviously Friday's activity in the NQ or just the NASDAQ marketplace as a whole was much more mild than the S&P. Another reason why it might be more favorable to look for short outcomes to participate through the pullback in your QQQ, in your NQ, the NASDAQ markets, because we're already starting to see a little bit of price action slowdown itself at that next higher high. If we take a look at the market profile, you'll also notice all of the same things we talked about in the S&Ps. Point of control value area did migrate higher on Thursday, as did they on the Friday session here. If we do start to pull back, there's a poor low from the Friday session, perhaps breaking down underneath this zone right here. That's at 14,460 in your NQ, 14,460 in your NQ, starts to develop that deeper pullback to our line in the sand, which is 14,240 in the NQ. Now, this is a very important place to be mindful of, specifically from the profile perspective. We have a poor low, then we make it a weak low with the overnight low going right to it, and then the Thursday low goes right to it as well. So structurally, there's probably lots of stop losses underneath that. If we run those stops, look left, there's your thin structure from the squeeze 2 Fridays ago. IWM monthly time frame chart. One of these things is clearly not like the other, producing an indecisive doji with a bar-to-bar higher high and lower low, and also very clearly stuck in a monthly balance range, whereas the Qs and SPY are clearly trending in the upward direction. So I'll always give credit where credit is due. If you want to be a bear, small caps is the place to be currently, especially if we take out those same comparisons with the Fibonacci from low to high. We're not yet back above the 38.2. We're still stuck in no man's land here, and this is still a pretty picture-perfect bear flag on the monthly. It hasn't broken the top of that flag range yet, and if we take out the fibs from high to low, we're still underneath the 38.2 ideal bear flag consolidation zone. So again, credit where credit is due. Good job, bears, in small caps specifically. However, if we take a more nuanced look at these smaller timeframes like the weekly, it's a tale of two ranges. There's your monthly bear flag range that we were just referring to, but here's a more micro little weekly range, and we've certainly broken that in the upward direction here. It's no noteworthy to me that there is a lower wick on this bar, indicating a test lower first, and then a very strong close over the top of the weekly balance range here, negating this as a potential weekly bear flag pattern. That is out of the picture right now. The next major overhead target would really become the top of the banking crisis candle, which is closer to 190. If we throw on the anchored view apps here on the IWM weekly, you'll notice that the break of the top of the weekly balance has been a recapture of the anchored view app from the October low, but we still have to contend with the anchored view app from the all-time high, and lo and behold, nice confluence of resistance right now at the top of the banking crisis candle. The next confluence of resistance at that same area comes from the volume profile on the weekly. Strong volume support underneath us. We've talked about this in prior episodes, and we're working into the low volume void overhead. Just keep in mind that the break of the top of that weekly range we just exited technically represented the top of this high volume node. I'm not calling for a full rotation up here, obviously, but the next major volume shelf that we should be paying attention to strikes me as this right here, right around 190, right at the top of the banking crisis candle. Let's take a look at the daily time frame chart and see what else we can learn about the IWM to build a game plan into this upcoming week's worth of trade. You can see once again clear as day, there's the break of the weekly balance in the upward direction. If we double that balance in the upward direction, a measured move takes us just shy of the top of the banking crisis candle. That's going to be around 186.75 from the nuanced daily level that you can see here, clearly produced the flush, right? So don't use 190, don't use that eyeball from the weekly time frame chart. Use the backtest of the flush here. In a picture perfect world, this produces a break, retest, and go, holding up at 179 as support. And we'll also remember that 179 support is coinciding with the anchored view apps from all of the major pivots after the October low. Remember that it acted as strong resistance at the top of the range here, preventing prices from breaking out in that upper wick of the bar. We sliced right through it like a hot knife through butter, and now on pullbacks, there's confluence of support with those anchored view apps when we're testing from the top side down. If that happens, once again, the rotation is for higher into the top of this banking crisis bar back here. If we do fall underneath 179, let's call a spade, we've got ourselves a look above and fail, and over time, the target should become the bottom end of the range. We'll take it in stride right now based on the broad market improving, all of these bullish indications improving. The first and primary objective should be to look for support at 179. We can do the same thing on the hourly time frame chart, checking in over here. You'll see that we have a bit of a short squeeze on the Thursday session, accounting for, 1 hourly bar accounts for all of the gains on the day. Then we go sideways. It's a different story on Friday. Some better buyers showing up on that session. The same thing can be confirmed here with the internals for the Russell specifically. I don't have the levels marked off, but very simply put, look at the comparison from last Friday to Thursday and Friday here. Last Friday, Thursday, and Friday here. Then the cumulative builds on the tick, of course, always speak for themselves. We can look at the market profile as well. Thin trending profile, no single prints. This is where the single prints show up. That's that short squeeze I was just showing you on the hourly bar. So once again, a pullback here probably wants to respect the top of this area. Something that does this, that way you're avoiding, it could even go further than that actually, now that I'm looking at the market profile, a retest to close the gap, even something that potentially tags this point of control on the Russell Futures RTY is the ticker there, /RTY. It's 1775. We've been talking about that in the pre-market live streams. That would be a mild pullback as well. It technically would get us inside of the range if we just go back on over to the IWM daily. Of course, what that would represent is a deeper move into like here, of course. So be mindful that maybe it's okay, but I really wouldn't want to see prices underneath 179. It wouldn't be my first thought if we're trying to remain bullish on the market at this point. These videos get notoriously long when we have monthly time frame charts to cover, so I'm not even going to remind you to hit the subscribe button. I just want to take this moment to say thank you if you've made it to this point in the video. You're probably already subscribed anyways. But Apple is up first on the chopping block, just an absolutely incredible chart, knocking on all-time highs basically. If we zoom in on the price action, how are we going to get involved? Well, if we take a look at what unfolded into the end of the week, we've absolutely gobbled up two back-to-back inverted hammers, produced a gap fill reversal, and closed towards the top of Friday's range. The chart is in the territory of the buyers. That is, very, very clear cut. In terms of trading it though, here's the hourly time frame chart. Any higher lows, any consolidation over 179 is healthy, and we're targeting the all-time high, 182.94. Breakdowns and lower highs underneath 179 can be traded in the downward direction, and your primary target is going to be a gap close under 176.75 closes at 175.75. Line in the sand pullback has to be 175 even. On the daily time frame chart, what you'll remember is that getting back down underneath that puts us back into this range. That would, of course, jeopardize the daily trend with a clear opportunity for a lower high underneath the bottom of the gap close. So that's Apple levels in a nutshell. Netflix is up next, not at all-time highs, but I mean significantly pushing in the upward direction. Inside bar being produced on the Friday session. Very simple setup. Over the highs, under the lows is your indication. If we take a look at the hourly time frame chart, nothing overwhelming about this. We've literally closed in the midpoint of that range, so be patient here. Over 405 gets interesting, or underneath 394.75. You probably want to wait for the lower high here, considering that we are in more of a daily uptrend at this point. Wait for the confirmation. Don't just blindly short the breakdown in Netflix. Here's Tesla. Let's go back to a daily time frame chart so I can illustrate where the next overhead target is coming from. Flat top back here at 230. This is basically an equal high to what we have in our rear view mirror, and the daily trend here is also clearly up. Higher highs, higher lows along the way. If we take a look at the hourly structure, you can see that a small pullback developed into the close of Friday. Any pullbacks that respect 208.25 intraday, looking for longs off of that level to rotate back to the equal high, and then a break of that puts 230 in play. Shorts are only on the table in Tesla with a lower high underneath this for a retracement to where the breakout came from, this most recent leg higher at 197.50, and then we'll take it in stride from there. Google is extremely interesting to me because if we go to the daily time frame chart, look at the big fake break from Friday, right? The upper wick starts to breach this range that we've been dealing with for quite a few days now. Then we promptly reject off of this equal high and close back in the range. Here's the hourly time frame chart. You can see it clear as day, right? Look at that upper wick, and then it's just sideways like at half back throughout the entirety of the day's session. So I would be looking for Google as a primary short candidate if the market is pulling back. The 124.75 breakdown or firmer close, any bearish pattern underneath basically should set up the full rotation into 122.15. Then beyond that, we'll look to sort of walk the targets down. 120.15's next, and so on and so forth. I would probably look to see what the broad market is doing when and if we test support at 122.15 and make an assessment in the direction of what the broad market is doing. Metaverse, what's going on with Zuckerberg's Fantasyland? Taking a look at the daily time frame chart, just a reminder, the gap has mostly closed, right? We did get our new uptrend in the gap. We've got a little inverted hammer on the Friday session though, and a very clear pullback area on the hourly time frame chart, breaking down under 270.50. This breakout point from the Thursday session should produce the pullback or start the pullback, and your first target is going to be the low of Thursday, 265.85. Anything underneath that, I would just take it moment by moment, trail your stop lower there. The better short indication is if there's a big flush and then a lower high has produced something that looks like this, you can clearly start to see the head and shoulders, right? So one step at a time, clearly in control of the buyers still, but watching for the pullback based on Friday's structure around 270.50. A primary outcome would actually just be a higher low here and then daily trend continuation in the upward direction off of 265.85. Next up is NVIDIA. This is still kind of too pie in the sky. This is still the hourly time frame chart. The only constructive thing we can say about this is that it's attempting, whoa, I don't know what's up with that wacky zoom. Let's try that again. It's attempting to produce a higher set of lows above the top of the earnings gap up range at 389.75. If anything, you should probably wait for the equal high break and then retest over $400.95, call it 401, and then you can sort of start to look for continuation in the upward direction. It's still just too pie in the sky. You need tight risk reward to get involved in something like this. Here's the daily time frame chart. I mean, we've gapped over all-time highs. We're sort of putting in this inverted hammer up here. Maybe it's trying to produce a head and shoulders, right? There's nothing concrete about it yet, so I'm still very skeptical about NVIDIA. We'll, of course, update you as more structure builds out, but we're just not there yet. Here's Microsoft, all-time high on the docket very, very soon. 355.50 break is the equal high break that gets us there. That's 343.50 in the upward direction. Here's the hourly time frame chart. Higher low pullbacks are what you want to watch out for over 331. Looking to be a buyer here and watch for moves in the upward direction. I would not be shorting Microsoft to try to capture this pullback. The only short is if we breach this and then lower high underneath 331. Next up, last but not least, the mini beast. We've got Amazon still on the hourly time frame chart, folks. Hourly time frame chart. This is an inverted hammer on the daily time frame. We'll see that in just a moment. The short indication is very clear. Breakdowns of 124.50, looking for deeper pullbacks to test 121.25. Here's the daily time frame. We'll see that inverted hammer. There it is. And we're looking for a retest for a higher low on the daily, flipping bullish if we see the structure that's there at 121.25. A couple of trade ideas and then I will send you on your way. If you've made it to this point in the video, let me know in the comments section. Are you watching on Saturday night, late at night, or early Sunday morning? I'm always curious when people tune into the show. With that said, AMAT is up first on the chopping block, and we do have ourselves a 3-bar balance in play, with the bottom of balance respecting prior structure here at 132.35, the prior pivot top. So structurally, this makes sense to me. With the hammer candle in play from Friday, long over the top of the 3-day balance, long over the top of the hammer, should produce a balance break, and we can look for the equal high on the daily time frame. That's 138.80. It would be a very rough doubling of this range in the upward direction. All good there. Next trade idea is on another A ticker. It's ARMK for AMRK, and this one just belongs in the museums of technical analysis. I mean, look at this picture perfect bull pennant going on over here. It's not in the strongest preceding uptrend, but nonetheless, the pattern is almost textbook. We have an inside bar from Friday. If we can breach the inside bar high, get over the red bar's high as well, take out 40, there's reason to believe we may see some continuation in the upward direction. Now, the price point here is not really ideal. It's fairly cheap in the options world, and also the options chain doesn't really have a whole lot of liquidity. This is probably a trade for swing traders to just put on a couple of shares over 40 and see what we can do in relationship to this previous gap. Can we close it? If so, you've got a nice payday. If we don't and we're unable to, you've got a tight stop with that support trend line. Last but certainly not least is going to be a revamp of Pinterest, or a revisit, I should say. That's PINS as a ticker. In the past, we had been talking about the 100% retracement, very difficult for that move to continue. We were looking for a pullback, and pullback we got. Now, it currently looks like a textbook cup and handle, and maybe this belongs in a museum as well, but not so fast. Let's take a closer look at the Friday price action. Large upper wick takes out the preceding bar's high. No acceptance from the buyers, and we close weak on the lows. All the while, the broad market is absolutely ripping in the upward direction. So, clear display of relative weakness, and if the broad market pulls back, I would look for continued breakdown out of Pinterest here. The price point, once again, is not great, but the options chain is a little bit better than something like your RMark. The target here, let's go on down to an hourly time frame chart, should become the neckline of this pseudo double bottom-ish type thing at 22, right? So if a larger breakdown unfolds, 22 is the area that you want to be looking for. That really led to the breakout in the first place. I'll give credit where credit is due. If the buyers poke it back up into the handle, then sure, it's a cup and handle, but we'll only trade it for longs when and if we can breach 24.50 in the upward direction. Once again, folks, if you've made it to the end of this video, you truly mean, like, your viewership means a whole lot to me, and I do appreciate you being a subscriber of the channel. With that said, I'll see you at 8:15 for the pre-market prep on Monday, and I wish you all a green trading week.